Okay, well, thank you again for joining us today. I'm going to get started here. Again, my name is Kirk Pollum, Managing Director in the North American CMBS Ratings Group for DBRS Morningstar. Today, I'm joined by Georgios Katsaros and Michael Fedorachko. Georgios is a Senior Vice President in the Ratings Group. Mike is a Vice President in the ratings group. We're also joined by Troy Dahl, who's counsel at Alston & Bird. We work with when we rate SASB transactions. So today we're going to talk about a methodology update we made in March 2021 to our CMBS single asset, single borrower methodology, and go through some of the really what were in effect non-material updates, but we made some clarifications and enhancements to some important aspects of the methodology that both Georgios and Mike are going to talk about. And then we're going to talk about just some current trends within the SASB world, and also have Troy talk about some of the legal considerations and aspects of SASB deals that we rate and what those are looking like. So with that, I'll hand it over to Georgios.
Thank you, Kurt. Good morning, everyone, or good afternoon, depending on your location. So we'll start with mentioning the updates that we released in the single asset, single borrower methodology earlier this month. And we'll start with the transitional asset valuation section that we added. So we added a section on the valuation of transitional assets, which builds on the main drivers of property value analysis, which are the DBRS Morningstar net cash flow and the cap rates, along with the LTV sizing benchmarks. This section effectively works through the various adjustments that we make to net cash flow and cap rates by introducing a couple of additional concepts. One is the net cash flow, but on an as-is basis, as well as on a stabilized basis, as well as an evaluation of the risks to the potential cash flow stabilization at the higher cash flow level. Now, these are all familiar concepts, but nevertheless, it will take us a while to unpack the components of this transitional asset framework, which are not explicitly stated in the methodology. And the first thing I'd like to focus on is a description of the type of property that we have in mind here when we speak about transitional assets in the single asset, single borrower context. So turning to Mike, what type of properties would you anticipate, Mike, that will be a good fit for the analysis that we're outlining in this new section for transitional assets? And conversely, do we see transitional assets and properties in the broader CMBS market that would not necessarily fit the bill for a SASB transaction?
Sure. Thanks, Georgios, and good morning, everybody. It's a great question because increasingly, I think that's a trend in the large loan market is assets with a transitional component, but broadly speaking, they still meet the bill for a SASB execution. So typically, in primary markets, very well located, good tenancy. But there's a transitional component to it. A good example recently is the 1440 Broadway deal that we rated in Manhattan. You have a property there where CIM, who's the sponsor, bought the property at about 50% occupancy. They had leased it up. And so there was, tenancy in place, but a number of the tenants were dark or looking to sublease their space. CIM was in the process of continuing to make capital improvements at the property. And so in that case, you have a SASB quality asset with a light transitional component with heavy structure around it. And so that kind of is a good example of a transaction where there's a lot of, there's a lot of good fundamentals. Whereas, obviously the CMBS sector has increasingly been an attractive, market for transitional finance. Particularly Series CLO assets, and that being a financing mechanism for transitional lenders. But typically, the collateral in those deals, they're in secondary markets or tertiary markets, and there's oftentimes a zero cash flow component, to some of those loans. But those are loans that really for us wouldn't fit the bill for this kind of a consideration in a large loan context.
That's great. Thanks, Mike. So we'll hold the notion of light transition. I like this. I like that characterization. And now that we have an idea about the profile of a transitional property as contemplated here, we can turn our attention to loan and transaction structural features. And with that in mind, we'd like ideally to sketch out kind of a menu of the structural features that we're expected to see. In various degrees and combinations, of course. I mean, every transaction is different. Now, the existence or absence of these features and their specific forms will be crucial in estimating the risks to stabilization and consequently the adjustments to the cap rate and or the LTV siding benchmarks that would be applicable. So this is, we're trying to build a framework, around this notion of light transitional assets to see what additional features we'll typically expect to see. Now, let's start with lease expenses and capex, right? So these are components that are required when stabilizing a transitional asset. Mike, can you describe potential structural features that would provide and secure these expenses, right? The expenses and the capex. How are sponsors working with issuers and obviously in the context of investor demand, how are they handling those?
Yeah, so it's a great question. And as I mentioned, there's typically heavily, these items are heavily structured around and for good reason in these deals. So typically there's either a future funding component where dollars are being reserved for upfront for accretive leasing or capital expenditures, which is, not unusual, but typically it's a sizable amount that's being reserved for in cash upfront. To continue with the example of 1440 Broadway, for example, there were, I think almost $27 million in cash reserved for future accretive leasing, about $3 million in CapEx. So you had $30 million being reserved up front. There was an equity contribution guarantee from CIM for another $20 million. And that loan was actually being cash managed, and there was cash being swept from the property day one up until I think 20 million. So in total, I think it was about $70 million of kind of structure, if you will, and kind of looking back to that transaction, our as-is cash flow was only about $4 million lower than our concluded as stabilized cash flow. So we're not talking about a super heavy lift, analysis from a cash flow perspective. So I mean, we're really looking for, I think, I categorize them into three big food groups when we're analyzing these things and deciding, is a stabilized approach appropriate or not. One is obviously structure, two is value, and three is coverage. And so we're trying to triangulate between the three and determine, is there sufficient structure to get us comfortable with a reasonable level of stabilization? Is there enough fundamental value in the real estate that you essentially have a backstop? And is the loan covering, even on our as-is cash flow? So those are, I think, the three factors that really play into how we look at those.
Great, thank you. So yeah, you mentioned some dollar figures there. So it seems like in dollar terms, these features can add up to, I think what you mentioned was probably just under 20%, but certainly over 15% of the loan amount. But it can go up to 30% or perhaps even higher. In your analysis, do you think there is a minimum level that you'd expect to see in terms of those features adding up to a dollar value? Or is it more a case of, case by case, depending on the property, given the viability of the lease-up costs and all of the related assumptions that go into deriving stabilized cash flows?
Sure. Yeah, I don't think we're looking for a specific, percentage, in terms of that dollar value. I think we're more looking to, make a determination as to how much upside or how much stabilization credit there really is what's plausible given the structure that's provided to us. I think we want to make sure that, there's no question that there is more than enough capital to achieve a very reasonable level of stabilization given the market. And that's why it comes back to, fundamental value and also coverage, right? We want to make sure the loan covers. We want to make sure there's enough fundamental value in the real estate. But more than that, we want to make sure that, we're only leasing up, for example, in cases where there's, a lease up component, there's ample dollars to do that, even, making very conservative cost estimates with respect to, leasing costs and, commissions and all that type of stuff.
Yeah, that makes perfect sense, and especially taking into account that there will be some variation in the amount of lifts required to reach stabilization. So it makes perfect sense that it's not a fixed dollar amount that we'd be looking for. Now turning to some of the legal considerations that round out the transitional asset framework, and turning to you, Troy, would you be able to give us a sense of the type of guarantees that a sponsor may be on the hook for in a structure like this?
Sure. It's one of the interesting things that I think we've been seeing more and more of this year and 2020 as well, is we're seeing more and more structure related to guarantees. CMBS has always been, a non-recourse market. So we don't really put that much credit into the guarantees. We've always had the recourse guarantee, which is more or less a backstop, it's the bad boy guarantee. We don't want somebody doing these bad acts. So we have that guarantee in place. But we are seeing more guarantees nowadays that are relating to the credit of the deal. In a few transactions, we've even seen carry guarantees. To me, carry guarantees was always an aspect of something like a construction loan or a transitional loan. But we've seen that. We saw it in the Timmick Mall in Columbia deal. We saw it in the 1440 Broadway deal that Mike was speaking about, where you've got a well-heeled sponsor stepping up and agreeing that they will carry debt service, operating expenses, and basically keep the loan afloat for a period of time prior to an actual foreclosure. So in that sense, they're not guaranteeing, the credit. They're not going to pay back principal, but they're going to keep the interest alive for a while. And, in an instance like 1440, where you have a transitional asset, that's a good thing. Until that gets up to speed, we've got CIM or, CIM entities on the hook to cover that. In an asset like the mall in Columbia, that if the retail situation would take a turn for the worse, you have Brookfield stepping up to make sure that that asset has the time to rebound, redevelop, and execute the plans that they need to. So that's been a very big factor, I think, from a legal that we're looking at. We've also seen a lot of other guarantees for things that have been previously reserved. And that maybe is a little less of a positive. Cash is always the best collateral you can get. So give us a choice between cash and a guarantee. I'll take the cash. But a well-heeled sponsor with the ability to do that, structured properly, we can understand that. So we've seen it in Blackstone deals. We've seen it in Brookfield deals. I think we've seen it in CIM deals, where you're going out and you're looking at, instead of reserving tenant improvements and LLCs, the sponsor is willing to put up a guarantee. Instead of the CapEx, the sponsor will put up a guarantee or a letter of credit. We've even seen it with interest rate caps recently on deals where instead of taking a strike price, the loan documents will have a strike price of 3%. But this will allow a sponsor to have a strike price of 4%, as long as they'll either fund a reserve or put up the guarantee. Now, an issue with there's a couple of issues with it that we have to address. From a legal perspective, CMBS, as I said before, it's always been a non-recourse loan. And DBRS and the other rating agencies, they're always looking to the cash flow from the property. A great sponsor is all well and good, but great sponsors have given back properties too. So you want to make sure that the property itself is supporting the loan. And the property itself is what's going to be responsible for paying back the loan, even if you've got these great guarantees. They're not guaranteeing principal, as I said. So we've got to make sure that the entity is still separate. That takes us into the whole bankruptcy realm, non-consolidation. And when you start having one entity guarantee another entity's obligations, you start raising bankruptcy questions. So usually these guarantees in the aggregate are limited to 10, 15, I've seen as high as 20%. Really depends on what their counsel is comfortable with and what they rationalize while they're talking us through the non-consolidation opinion. So while we've all, as lawyers, looked at way more non-con opinions than we all care to think about, in these instances where we've got these complex guarantee structures in place, they take a whole new meaning. It's not dotting an I and crossing a T. We really need to look into it and make sure the logic and rationale for that guarantee, for that opinion, is accurate and it addresses the risks involved. The other structural aspect, and less legal in nature, but very rarely are you looking at one of these deals and seeing Brookfield, parent company, signing a guarantee, or Blackstone, the ultimate entity, signing a guarantee. It's going to be one of their entities. And it's a very well-heeled entity. But one thing we've got to look at is we've got to look at where the net worth and liquidity requirements are coming in on these transactions. They need to be a substantial amount of net worth in particular. It needs to be a substantial amount of the loan. If you've got a guarantee signed by an entity that doesn't have a net worth requirement, it's not very meaningful because they can take that money out of the guarantor. And while we all want to have everybody trusting in that, it's our job as counsel to make sure that it becomes legal, documented requirements. That's probably a fairly good summary of the guarantees we're seeing these days.
That's great. Thank you. That's I don't even have to read between the lines here to figure out that, it's one thing to come up with an overall number of that support that's provided by this framework we've been talking about, but the weights, right, that would assign to, upfront cash versus various cash lock boxes versus the guaranteed amounts are different. It's not, we don't treat the same, the various sources of support. I think that's very intuitive. And the other thing that I think is very interesting is that the percentage, the maximum percentage of that guarantee is potentially limited by non-consolidation considerations. So that's another very interesting feature. Thank you, Troy. All right, so moving on, a second addition to the recently published SASB methodology is a provision regarding portfolio diversification in SASB transactions. So here we're addressing transactions with exceptional granularity and significant portfolio diversification. And in those cases, the methodology provides for the option to increase the portfolio diversification credit above the typical cap of 7.5%. Now, to dive in a little bit into that 7.5 and where it's coming from. So we're looking at portfolios with minimum Herfindahl scores of 15 with respect to property count, a score of 10 for MSA count, and a 5 HERF for state count. And that would basically sum up to the maximum of 7.5%. Now, given that, exceeding that 7.5 would only be considered for highly granular portfolios. So, a first question that would come up here is, why do we need to do that? So I wonder if, Mike, you can give us or describe rationale behind this provision for additional property diversification, above that 7.5 figure, and also maybe a sense of the type of the property portfolios that may earn that credit above the cap of 7.5%, as we discussed it. What does this property portfolio look like?
Sure. Yeah, it's a great question. So as Georgios alluded to, there is an exception built into the methodology that was published in March for these very, very granular, highly diversified portfolios. And so, the methodology contemplates, for example, a property HERF of 15, essentially being the maximum, above which you receive the maximum tranching credit. And so, increasingly, the CMBS market is an attractive option, and frankly, in a lot of cases, sometimes the only option for exceptionally large portfolios of assets. And so, there are a couple of things that we think about. Number one, the way we tranche portfolio diversification benefit is very important. I think, anybody that knows anything about structured finance and CMBS knows that you don't want to be long diversity at the bottom of the structure because, at the bottom of the structure, the more diverse the pool of assets is, the higher the cumulative probability of something going wrong at one of those properties becomes. And so we tranche our pooling benefit down to 0 at B. And so, that first loss piece doesn't receive any benefit of pooling. Whereas at the top of the capital structure, you want to be long diversity because you're more worried about kind of large idiosyncratic risks, creating a very sizable loss to the portfolio. And from our perspective, that's just less likely when there's tremendous diversification. But the other thing that you touched on that I think is important to note is we curtail portfolio diversification for property types where there's a lot of macro correlation. So for example, hotels typically will receive a cap of 4.5 points of diversification credit because of how correlated the hotel industry is to the macro economy. And obviously we all have seen, the fallout and the real world implications of that correlation, throughout the COVID pandemic. So those are portfolios where we really have to take a harder look at things and decide whether or not, they're sufficiently insulated from that macro correlation or not. A good example might be, extended stay hotels, which have performed very well through COVID as a result of the demand drivers there. We talked about that on our new issuance webinar a couple of weeks ago. And there are other property types where, you have sufficient, industrial is one where you have a lot of tenant granularity as well, with exposure to a lot of different industries. So those are portfolios where we might consider providing additional credit. But as you alluded to, the maximum pooling credit, provided for in the methodology is 7.5 points. If we were going to go above that, we probably would not be, any more than 10 points total. So potentially 2.5 points of incremental credit for portfolios with, very, very large, property HERF scores. And we've seen some of those in the past couple of years in the CMBS market, some of them with property HERFs of 100 or 150 or greater, where that might be a consideration for us.
That's great. So yeah, we have a few takeaways here. So even though we may go above that 7.5% implied cap, it won't be by much, right? As you said, probably bracketed around at the 10% level total. as well as your explanation, which I thought was very, very good and very interesting about, we're looking at HERF, in the methodology, and because it's a very common measure of concentration, but in some cases, there can be other types of correlation depending on the assets in the portfolio that we also have to take into account. So that's very important. And finally, the notion of tapering, applying the maximum credit at the top and reducing gradually down to zero at single B, which also is, as you said, an intuitive concept. So we'll hold on to this idea of tapering because we're going to talk about quality and volatility adjustment, which is not necessarily a new concept in the methodology. It existed there, but there is a small tweak here. But I figure we might as well go through some of the concepts that are part and parcel of the quality and volatility adjustment. So in this context, let me just say the quality volatility adjustment is in fact a trio of adjustments. They address property quality, cash flow volatility, and market fundamentals. Each one of these can be a positive or a negative adjustment. And the overall quality and volatility adjustment is the sum of those three adjustments and can often be one of the more impactful adjustments to the base LTV sizing benchmarks. Now, this tapering is not very similar to the tapering that we discussed with respect to the diversity, because we actually apply it upside down. So the full value of the quality and volatility adjustment is applied here at the lowest investment grade rating at BBB low, with the quality and volatility adjustment decreasing towards the higher ratings and reaching only a fraction of the full value at AAA. If my memory serves right, for commercial properties, that fraction is 50%. For hotels, it's lower than that. It's about 20%. So, Mike, in the context of tapering the quality volatility adjustment, can you help us understand what drives this tapering to be applied? Well, first of all, why do we need it, and why do we apply it in the opposite direction of the diversity tapering? Are we confused, or what's going on?
Yeah. So the qualitative or the quality volatility adjustment is one of the key analytical drivers, in our large loan ratings approach. It gives us the ability to, differentiate between different assets, by adjusting the baseline LTV sizing benchmarks, as Georgios mentioned. And so, typically for, a kind of commodity SASB type transaction, those are tapered, right? And so, as Georgios alluded to, they're tapered in the opposite direction of the pooling. And the rationale behind that is, at the lower rating levels, we can be more generous with respect to some of our assumptions, because the implied, loss severity and the ability to withstand those, that volatility is much greater based on our ratings definitions than it is at the higher ratings, rating categories. So that's why, we typically taper up to, 50% of the benefit for commercial properties up to AAA, and 20% for hotels, which are, as previously mentioned, historically much more volatile with respect to their performance and their recovery profiles. So that is just very consistent with our ratings definitions. We want to be more conservative at the higher rating levels than we are at the lower rating levels. And so that's what drives that gradation. But the important takeaway is, that is less of a consideration for what we would consider exceptionally high quality real estate assets, where, there's tremendous cash flow stability attributable to credit tenants, limited rollover in the case of, maybe an office building located in a primary market. So some of those factors, come into play when thinking about, the potential to apply those qualitative adjustments flat up and down the structure, and get to an appropriate rating level for a transaction with, very, very favorable credit characteristics.
That makes perfect sense. Thanks for explaining that, Mike. And that's exactly the new feature and the new component that we're introducing in this update of the methodology, where there are certain cases where that tapering would not be applied, as Mike mentioned, in this very high quality type of assets. And just to close the loop there, the other case where we would not taper the overall net adjustment is if that adjustment happens to be negative. So if that is the case, then it will be applied flat across the capital structure. Great. So we'll move on to another topic, which I understand can be very interesting in some market participants and in some of the deals that we have seen. So this has to do with amortization credit after an anticipated repayment date, or an ARD. So we have a section on amortization credit in the methodology even prior to this update. What we did here is we introduced some nuance that talks about how we would apply amortization credit in the cases that there is an ARD and some additional factors and conditions are met. So Mike, can you walk us through the factors and the conditions that go into this determination of potential credit for post-ARD amortization?
Sure. So yeah, I think we'll probably touch on some of the market trends that I think are driving these structures at the present time, and I think we might have even touched on that during our last webinar. But an anticipated repayment date structure, is essentially a date, essentially a maturity date, after which the loan is permitted to extend into that ARD period. But there are several economic disincentives that essentially make it an unattractive proposition from the perspective of the sponsor to continue to extend the loan past that ARD date. So, typically that includes penalty interest on the mortgage and the mezzanine loan, if there is a mezzanine loan. But probably most importantly, and from the perspective of how we look at these, is essentially, the diversion of cash flow from the property. And so typically, the structures that we're seeing, cash flow from the property after the ARD date is diverted to hyper amortize the mortgage loan during that ARD period. So there's significant deleveraging that could potentially occur during, into that ARD period, depending on the length of the ARD period and the number of other factors. And so we'll get into actually a quick example, that I'll bring up on the screen, just kind of walk everyone through how we're thinking about this and how we're applying that benefit. But the important thing to know is that, that benefit is only applied in cases where we have a rated cash flow profile during the ARD period. And what I mean by that is we have cash flow attributable to a credit rated tenant without any termination option during that ARD period. So you essentially have a rating profile to that cash flow stream during that ARD period that we can rely upon to hyper amortize the mortgage. So I'm going to pull up a quick example, hopefully that is helpful, given some of the inquiries that we've received on this, and just the fact that a lot of these are a lot of deals with this structure in the market. So, here's a purely hypothetical example of a let's call it an office building with a $200 million mortgage loan and a BBB tenant, with a lease that extends through the year 2030, maybe a 5-year initial term, with a 5-year ARD period after that. And so what we do first is determine how much cash flow after debt service is available to hyper amortize the mortgage during the ARD period. And so we look at, the base rent of the credit tenant during that period. We factor in the recoveries, our vacancy, We come to an EGI number. We take our DBRS Morningstar underwritten expenses, and we apply those and we compound them through the 5 years of the analysis. So we're essentially looking out over that 5-year period to determine what is the actual reliable cash flow after debt service that will be derived from this particular tenant at this building. And so it's important to note that the cash flow after debt service obviously includes the debt service, right? And so calculating the debt service becomes an important factor in determining how much hyperamortization we can expect. And so obviously, as the mortgage loan is amortizing, the debt service due on the mortgage loan is being reduced, right, over a period. So we have to look month by month to figure out, what the actual debt service due is going to look like. You'll see here we have a number of considerations as well that are going to determine how much debt service is due, namely, what the coupon is on the mortgage and the mezz loan, if there is a mezzanine loan. As I was kind of alluding to before, what the penalty interest is, and whether or not that penalty interest is deferrable during the ARD period. Because obviously, if it's not and it's current pay during the ARD period, then we need to factor that in and keep that mortgage loan current. So these are all factors that are going to drive how much debt service is due during the ARD period, and therefore how much cash flow after debt service is going to be available to pay down the mortgage loan. Another important consideration that we need to look at is whether or not the mezzanine loan is paid down or hyperamortized pro rata with the mortgage. So to the extent the mezzanine loan remains outstanding during the ARD period, we would typically expect the mezzanine loan to be paid down or hyperamortized, pro rata. And when I say we expect, I think that's less of a credit consideration for us and more just an economic reality, I think, for the mezzanine lender. Not wanting to essentially remain outstanding while the mortgage above you hyperamortizes. So those are all important factors in determining kind of that first step, how much rated cash flow we can expect during this period. We then come down here and we have, typically when you have a credit rated tenant with this much hang, you're going to be eligible for long-term credit tenant treatment in our cash flow analysis. And so there's typically a fairly substantial benefit to that cash flow. And that typically is straight line rents through the loan term, a vacancy reduction depending on the rating, and typically no TIs and LCs. And so there's a lot of value baked into that cash flow profile. And so, we have to take into account the fact that at the end of the ARD period, that ARD period is coterminous typically with the lease expiration of the credit rated tenant. And so when we look at what our exit DBRS Morningstar LTV is, we have to look at the mortgage loan hyperamortized balance on a value that's adjusted for the fact that credit rated tenant is no longer going to be in place at the end of the analysis. And so that's why we have two cash flows. We have our cash flow with all of the credit tenant treatment, which is essentially our value day one, but our exit LTV is going to be based on our value with that benefit stripped out. And so we're going to be taking TILC costs into account, obviously, over time to, in our cash flow to re-tenant the property, at the end of the lease term. So when we look at, in this example, about $51 million of cash flow after debt service is available during the ARD period. And so we have a mortgage loan beginning balance of about $200 million in this example. So we have a day one loan to value on our DBRS Morningstar value of about 96.1%. When we look at the ARD maturity balance of about 148 million, so the 200 less the 51, we come to a DBRS Morningstar exit LTV of about 93.8. So there's about 3 points of amortization benefit in this scenario. It obviously would be much more substantial if we looked at an exit LTV based on this long-term credit tenant value. But again, as I mentioned, that tenant is presumed to be leaving the property at the end of the analysis. So that's why we're using that lower $157 million value. So we have about 3 points of amortization credit, essentially, based on this analysis. And we'll provide that 3 points of tranching benefit, starting at the bottom of the structure up to the rating of the tenant. And so in this case, if we have a tenant with a rating of BBB high, for example, we would provide that benefit only up to the rating of the tenant. And so, if the baseline LTV hurdle for this particular transaction was this vector shown here, we would gross up each one of those tranching hurdles by about 3%. And so, as you can see, it works out to be, about 2.4 points at BBB high, and kind of widening out to about 3 points of benefit at the bottom of the structure. So essentially what we're doing is we're providing benefit at the bottom of the structure for the fact that there's a mechanism in the mortgage loan to reduce the maturity risk of the mortgage. So that's kind of a high level walkthrough of the ARD approach. I think the one other thing that I would mention is the methodology provides for baseline amortization credit, regardless of whether or not the cash flow is derived from a credit tenant or not. So if a mortgage loan, has planned or scheduled amortization, there is a modest benefit, tranching benefit to having that planned amortization. When the methodology was originally constructed, those amortization benefits were based on kind of median time to default analyses that we ran on some of these loans, and some of the property types as well. And so in essence, we also look at what the implied amortization kind of profile would be, even if there were no credit tenant direct cash flow, for example. And so if you look at the $148 million, that we're amortizing down to from 200 million, that approximates about 30-year amortization schedule. So about 3 points of amortization. It just happens to work out to be similar to the amortization factor that we calculated previously. But we would consider providing that tranching benefit above the rating of the tenant. It's typically a fraction of kind of the amortization factor, a point or 2 points, sometimes even less. And so we would consider providing that above the rating of the tenant, kind of in addition to this analysis, when you have this type of a structure. And, again, the rationale for that is there would be some benefit provided up and down at each rating level, even if it were an unrated tenant, and there was, scheduled amortization such as this. So there's kind of two components to the approach. It's certainly not, it's a nuanced approach, but I think at the same time, it's important to be detailed when you're looking at these to determine exactly how much benefit to provide. And I think it's important to note as well that each ARD can be structured a little bit differently. So sometimes, these are case by case type of analyses.
Great, thank you, Mike. That's definitely a lot of useful information there, and definitely get a flavor of what goes into determining credit for this concept, which on its face is fairly straightforward, but once you take into account the considerations that you mentioned, I think it becomes evident that you need to walk through various scenarios and see the impact to the structure. So switching gears, we're going to switch to another topic, LIBOR transition. So recent announcements from the Intercontinental Exchange, ICE, which is the administrator of LIBOR, and the UK's Financial Conduct Authority, which is the regulator of LIBOR, they triggered the pre-cessation trigger and fixed the spread adjustments for the IBOR protocol. And therefore, that cleared the path for the transition away from LIBOR. And we have some relevant cessation dates: December 31st of this year for all non-US, as well as the 1 week and 2 month LIBOR. US LIBOR settings will not be provided, or may not be representative, even if they are provided past that date, past the end of the year. And then June 30, 2023 for all of the other US settings. So I'm going to turn to Kurt now and ask, how is CMBS navigating this transition? Obviously, we have heard a lot about this over the last few years. So how is CMBS navigating this transition broadly, and what's happening within the DBRS Morningstar, in particular the CMBS group, that's sort of looking at this transition coming forth?
Sure. Well, I'll start with saying you said broadly. This topic could probably take up a whole additional webinar in itself. Obviously, with the announcement from the FCA and then from ARC, which is the Alternative Reference Rates Committee, and also ISDA, we have seen just in the last few weeks since that announcement, we've seen additional evolving of the language, both in the loan agreements and then in offering circulars. And basically, what we're looking at still is broadly, the CMBS market is still very much originating LIBOR-based floating rate loans. Haven't seen currently any indication that that's going to stop. The deadline, the drop dead deadline, of course, is the end of the year. Guidance right now is from regulators is, hey, big banks, you should think about stopping your LIBOR-based loan origination before that. But again, haven't seen that. And then on top of that, this kind of will blend into the trends we're seeing. Everybody's pretty aware at this point, right? The treasuries and treasury yields have really gone up substantially since last year. LIBOR has stayed really low. So we've seen the lion's share of these SASB deals are floating rate LIBOR based. The things we're really paying attention to, especially recently, is the language that allows for the transition from LIBOR to something else, right? And if you want to get a feel for what all the considerations are, just get yourself an offering circular and read what the disclosure is and the risk factors, and you'll get a feel for that. And it's currently, I would say what we're looking for, and I think what the market's doing, is they're trying to make it as flexible as possible for what are still a lot of moving parts and things we can't quite nail down. And again, I could get into and Troy could get into this too, and the details we're seeing. But basically, we know that LIBOR is going away. We know that the cessation of, or the publication of all tenors and all currency-based LIBORs, with the exception of US 1 month LIBOR, are the end of this year. We got a reprieve till June 2023. However, that doesn't mean that as we go along that's necessarily going to continue to be relevant. We don't know how that's exactly is going to work. So the flexibility in the documents right now contemplates what the alternative index might be, and it's starts with term SOFR. Really, it's is currently just what's highlighted as number one, then compounded SOFR. And then there's a fallback for, basically an index that we can't currently contemplate, but could become sort of the prevailing market. What the market believes is the index that everybody will gravitate to. I want to also point out that servicers they're left in the position of having the discretion to figure this out. And while we have this, what's been basically officially ARC's position that this is a LIBOR transition event that's occurred with the announcement on March 5th. They are not the authority on this. They're a public-private partnership that is offering guidance on this. Ultimately, it's the regulators that are going to sort of start to really push on starting with the big banks just to move away from LIBOR. But again, in the language we're seeing a few things. Term SOFR, right? We don't know if that's actually going to happen. The problem is people have started to voice the concern that term SOFR would actually cannibalize overnight SOFR and make that not work. So the two would, you can't have one without the other. So how's that going to work? Compounded SOFR is also a problem because we have arrears versus an advance. Servicers, for one, are saying it's got to be an advance because doing it in arrears is going to be difficult for them operationally to pull off. And and finally, we don't know. I mean, of course, we have, in addition to all this, the layer of you have to have this adjustment, this rate adjustment spread attached to SOFR. Because SOFR is much more of a risk-free rate compared to LIBOR, which has this embedded credit risk component in it. And that spread adjustment is meant to compensate for that. Well, if that's being set, I believe at like a 5-year average or something that's an average and not currently market, how is that going to work out? And by the way, it actually won't, in most cases, take effect until 2023. How much is the market going to change between now and then? So I guess what we're seeing and what the market's doing is they're just trying to provide as much flexibility in the documents as possible to be able to navigate through what currently is still a lot of variables. I'd say the most recent thing that I've seen in the deal transaction we rated, which is the big Life BMR Biomed transaction. That's Blackstone, of course, which is, as we all know, a very large, prominent borrower in SASB, CMBS. They actually explicitly have put into the documents Prime as a fallback, in addition to just SOFR or some other alternative index. And so I'd say, and I'll have Troy add to what he's seen, but that's just on a broad basis, kind of what we've been seeing recently.
Yeah, I think I would agree. I think probably the simplest way to sum up, the trend on it is there isn't necessarily a trend. It seems like we're seeing different language in just about every deal. I would agree with Kurt that we're seeing issuers have a lot of flexibility on it, and that we saw one deal literally last night. We just got the loan agreement, and it has an anticipated benchmark replacement date of July 1st, 2023. So you're looking at it; it's still a little bit down the road, and fortunately, we're all considering what's happening with it right now. I don't think anybody is confident what that's going to be. And it certainly could lead to, some problems. I mean, one of the requirements is, generally speaking, to get a, new interest rate cap or to amend the interest rate cap, whichever you're able to do.
Right.
And right now, I mean, it's not my primary area of expertise, but I don't believe there's anybody that's willing to provide an interest rate cap based off of term SOFR or compounded SOFR or who knows. So that, once we figure out what the rate's going to be, what are these rate caps going to cost borrowers out there? And that's
a huge consideration.
Yeah.
Right. Yeah, and I was going to bring that up. These loans can't extend past their initial maturity date unless they have a replacement rate cap agreement. And how that's going to work hasn't necessarily been figured out yet. There's not a depth in the derivatives market right now that can currently replace LIBOR. There's not, as we mentioned, not term SOFR. I was going to mention, because we're going to run out of time, again, because this is a topic that we could speak a lot more in detail on. The other provision that we're seeing, Troy, I believe, is this early opt-in provision, which gives the servicer the additional flexibility based upon prevailing market conditions to transition early, if it makes sense. And that is, again, that's just speaking to sort of the flexibility that I think that we're seeing. And because it ultimately, this is still going to happen. Borrowers, lenders, borrowers, investors, certificate holders are going to have to adapt to it. But I guess the main point is that we're still in a time where we can't really figure out what we're going to be in a year or 2 years. And in the meantime, there's no indication that that we're seeing banks veer away from LIBOR-based loans right now, and at least in CMBS. As we all know, that Freddie Mac has been in front of this. They've done, I believe, one SOFR-based deal, and they have transitioned to SOFR, but the private market and the big banks, no indication yet of when that's going to occur. So I don't know if we have, well, first of all, we're out of time. I don't know if we have any questions that have come in, but we'd also certainly be able to follow up with anybody that has questions as a result of the information we presented in this webinar. And Georgios and Mike and Troy, thank you very much. Great explanation of some of the finer details of how we look at SASB transactions at DBRS Morningstar. And again, if anybody has questions, reach out to us, and any one of us can go ahead and get back to you. With that, I think we've reached 12 o'clock. Thanks again, everybody, and we look forward to seeing you in the next webinar.
Thank you all.
Thank you.
Thank you, everybody.